Supply and demand zones work great on their own, but like all technical concepts, the success rate of zones can be improved further. How? By watching for zones to form at specific points on the chart, or in other words, by watching for confluence. Confluence is when two or more technical points line up at the same spot on the chart. For example, if a support level falls in line with a demand zone, that's confluence. The level exists at the same point, so it increases the probability price will reverse, because now there are two factors co-occurring at the same spot. There are many points of confluence you can use with supply and demand zones, from fib retracements, indicators, support and resistance levels, etc. However, there are three main points you should always concentrate on that provide the strongest confluence and the best chance of causing price to reverse. Here's what they are and how to use them. Here's a fun little test. Open up the 1 hour chart on whatever pair you typically trade, so long as it's a major or minor, don't try this in any exotics, and mark an arrow or line on the point where the largest reversals originated from. Now, look at the nearby prices. Notice anything? See anything odd and out of place? Look closer. What you'll find is that most of the biggest reversals originated either at or very close to big round number prices. Prices ending in 3 zeros, 4 zeros or 500. Here's one I did myself earlier. Every major reversal during this segment of price action began when price was at or close to a big round number. Coincidence? No, it's because big round number prices are some of the most powerful points in the market. Big round numbers are a powerful magnet for buy and sell orders. Many traders, both retail and institutional, banks, hedge funds, etc., place their buy and sell orders at big round number prices, one because it makes the order easy to remember due to being round, and two because of how significant those prices appear to be. I mean, tell me, how many times have you seen news state prices close to breaching a big round number? It happens all the time. So naturally, people place their orders at the number to get in. As a result, thousands of orders build up around big round number prices, orders the banks can use to help get their positions placed. This is why price reverses from big round numbers so frequently. The banks use the orders to help enter their own positions. They push price into the orders, then enter their trades. That's why most big reversals begin near big round number prices. Remember, the banks can never enter their full position all at once. In other words, they can't buy or sell their full amount in one go. Their positions are so huge that they never have enough opposing traders buying or selling. They must place one set of positions, then place the second set later. That's why price returns to supply and demand zones. That's the banks getting their second positions placed. Because of this, the banks always look out for points where lots of orders build up. They know they can use the orders to help get their positions placed. That's why we see things like stop runs. The banks use the stops to enter more positions before price reverses. Now, because of how many orders build up around big round numbers, they make the perfect points for the banks to push price to help get their positions placed. If we look at this chart, for example, this is roughly how the orders distribute around big round number prices. This shaded area, this isn't a supply zone by the way, is where the orders are found. Once price returns, it hits these orders and the banks enter their positions. Price then reverses and a large down move gets underway. So how do we use big round numbers as confluence with supply and demand zones? Well, we just look for zones that form at or very close to big round number prices. If a zone forms within 150 points of a big round number price either side, they have confluence. Let's go through a quick example. By the way, quick note, big round number confluence only works on timeframes below the 4 hour. You can't really use big round numbers on the daily or above because the prices are too close together. You'll have multiple big round numbers within every daily or weekly zone, so they don't work that well. They still provide some confluence, but it's not as powerful as what we see on the lower timeframes. Anyway, back to the example. So here we have a nice rally-based drop zone that's formed on USD Japan. To see if this zone has confluence, we must look for the nearest big round number. If you look closely, you can see the 105,500 big round number runs straight through our supply zone. So this zone has confluence with a big round number. Its power is increased. Price is more likely to reverse at this zone when it returns because additional orders have built up due to the big round number existing at the same point. The banks can get more positions entered, which makes a reversal more likely. And as you can see, when price returns to the zone, it reverses and a large downswing begins. Now keep in mind, just because a zone has confluence with a big round number, that does not automatically make it a strong zone. The zone's strength overrules confluence. Just because a rally-based rally zone forms at a big round number doesn't mean that zone is now stronger than a rally-based drop zone. The zone's strength, the length of the preceding move, overrides any confluence the zone may have with other technical points. Confluence is only meant to back up what you think, not override the core rules for how the zones work. So keep this in mind, not just with big round numbers, but the other points of confluence seen here. Let's look at the next point of confluence now. Another great, though maybe unexpected point of confluence is higher time frame supply and demand zones. Generally, higher time frame zones are stronger than lower time frame zones, and that scales with time frame. The higher the time frame, the stronger the zone. This is because it takes a lot more force, money, to move price on a higher time frame than a lower time frame, okay? For price to rise on the daily, for example, the banks must buy from everyone selling on the time frames below, which is a lot of traders. So that means the banks must buy way more to make price rise on the daily than on something like the 1 hour, because more traders are selling due to the lower time frames. Now, like Forex itself, supply and demand zones are fractal. Lower time frame zones form inside higher time frame zones. A daily zone will contain multiple 1 hour zones, which itself will contain 15-minute zones and so on. As a result, a lower time frame zone that forms within a higher time frame zone is typically stronger than a zone that doesn't form within a higher time frame zone, because it's likely the higher time frame traders will want price to reverse from the higher time frame zone, where they want to buy or sell, the lower time frame zone, as that's where they bought or sold before to create the zone. Here's an example. This 1 hour zone formed within the daily zone. That's the black outline you can see. If price returns to this daily zone, the 1 hour zone is the most likely point for it to reverse. Why? Because it's where the banks enter their positions to create the daily zone. Remember, lower time frames just give us a more detailed picture of what happened on the higher time frame. It's like looking at a picture from far away and then zooming in to see the details. From far away, you can't make out what's going on, but once you zoom in, everything becomes clearer. You can see the details of the picture. That's how time frames work in Forex. Our 1 hour zone formed from the bank traders on the daily entering their positions. We just can't see this on the daily because it doesn't show as much detail as the 1 hour. We're seeing the picture from far away. The close-up details aren't visible anymore. So our 1 hour zone has a higher probability of being successful then. It's the most likely point for the daily traders to enter their remaining trades. Let's see what happens. As expected, price re-enters the daily zone, that's the black outline, and moves into the 1 hour zone. It then produces a nice engulfing pattern, which was a great entry signal, before reversing out of both the 1 hour zone and daily zone, providing us with a successful trade. Now, what if you have a situation where multiple lower time frame zones form within the higher time frame zone? What do you do then? In this case, you have two options. Either trade the zones individually, or just trade the higher time frame zone. There are pros and cons to both. If you trade the lower time frame zones individually, you run the risk of price reversing in between the zones or somewhere else, which does happen often. However, your risk will be lower. You won't need to cover the gap between the zones or the area to the most recent swing low or high of the daily zone. If you trade the higher time frame zone instead, your risk will be higher because you're covering a wide area, but at the same time, you won't need to worry about price reversing in between the lower time frame zones. That's the trade-off you get with each option. In my experience, it's better to trade the higher time frame zone when two or more lower time frame zones form within a higher time frame zone. While it is possible to trade the lower time frame zones individually, price fails to reverse at the zones too often and instead reverses in the gap or in the space between the swing high or low, causing you to miss the trade or lose money. For that reason, I think it's better to just trade the higher time frame zone when multiple lower time frame zones form within. Sure, the risk is a little higher, but at least you know you're getting in if price reverses, which you can't always say when trading in lower time frame zones. Now, if you want to use higher time frame zones as Confluence with lower time frame zones, it's really important to only use specific time frames in conjunction with one another. That way you won't be overwhelmed with zones. Like, it doesn't make sense to watch 5-minute zones to form within daily zones, because there'll be so many zones that you might as well just trade the daily instead. It won't be worth trading each individual zone because the risk will be huge. Here's a list of what combos I use in my trading. The other time frames aren't really feasible due to being either too short, like the 1 minute, or too long, like the weekly and monthly. Too many zones will form within these zones, so it's not really feasible to use them as Confluence. And now let's look at our final point of Confluence. And finally, we have our last point of Confluence, support and resistance levels. Now, support and resistance levels need no introduction. If you have even a passing understanding of Forex, you'll know what they are and how they work. If you don't, they're basically lines where price has a high probability of reversing. Imagine supply and demand zones, but with lines rather than zones. That's what they are, same concept, just different execution. Given that support and resistance and supply and demand zones form under the same process, from the banks buying and selling, albeit in different ways and for different reasons, they make great points of Confluence to watch for zones to form at. Now, for the most part, using support and resistance levels as Confluence works the same as using big round numbers from earlier. You mark a zone on the chart, then see if a support or resistance level strikes through. If it does, like in this case, they have confluence with each other. You can trade the zone with the support level as confirmation. There is, however, one key point you must be aware of, that is, the support or resistance level is only valid if it hasn't been recently broken, okay? Price must not have broken the level on the last two touches or more for it to be valid. If it has, the level doesn't provide confluence, it's invalidated. Support and resistance levels form due to the banks placing their positions, just like supply and demand zones. The difference is they mark a point, a price, where orders build up behind the scenes, kind of like big round numbers, only with a lot less orders. So naturally, the banks often push price to these levels to help enter their positions. That's why we see price reverse from support and resistance levels over and over again. It's the banks entering their positions using the orders that are built up. This is primarily because of how well known support and resistance levels are today. Nowadays, so many traders believe and understand the concept of support and resistance that they place their orders at the levels, thinking price will reverse, which it sometimes does, furthering their belief in the levels. So it becomes almost a self-fulfilling prophecy. Orders build up at the levels because people believe they exist. The banks then use the orders to help get their positions placed, which causes price to sometimes reverse, validating the concept in the minds of traders. Now, if the banks are using levels to get one major position placed, like a huge trade, they'll always split the trade up to lessen the number of opposing buyers or sellers needed, same as what they do with supply and demand zones. Once they split the trade up, they place the first trade, which appears as a bounce from a support or resistance level, and then place the second trade around the same point, causing the second bounce. Because by doing that, placing the second trade at the same price, they replicate having one huge trade placed at a single price, which is what they would want if enough buyers or sellers were free, and they didn't have to split their positions up. On a chart, this shows us price failing to breach a level 1, 2 or even 3 times. Each failed break is the banks entering another trade. You can see this on the chart. Trade 1 caused the first bounce, which was only minor. Trade 2 created a second bounce, which caused price to reverse. So if a demand zone now falls in line with this support level or is very close to it, we know it has a better chance of causing price to reverse, because we know the banks have already placed trades to create the level, hence the 2 bounces we've seen. If they want these trades to remain open, they must make price reverse from the zone, otherwise they'll lose money. If we move forward then, you can see later a demand zone forms just above the support level, which price reverses at after returning. Price reversed here because the banks placed more trades. The bounces from support were their first couple of trades to test the waters if you will, and then the demand zone plus the return were caused by them placing their larger trades. So do you see how support and resistance levels provide Confluence now? They clue us into where and when the banks might have placed trades or other positions. So when we see a level form in line with the zone, we know the banks have already placed trades. That's what the 2 or more unbroken touches tell us. When that level coincides with a zone, we know it has a better chance of causing a reversal, because if not, the banks will lose on their trades. They must make it reverse. Go back and look at some support and resistance levels that formed in line with supply and demand zones, and you'll see this yourself. Zones that form in line with unbroken levels, at least 2 touches, typically result in large reversals. That's because the banks have placed a bunch of trades to make price reverse, hence why we see the touches and price create and then reverse from the zone. So those are the 3 main points of Confluence you should watch for supply and demand zones. Check for these when you see a zone form. They'll keep you trading the good zones. Obviously they won't work all the time, again that's trading, nothing is certain, but they'll definitely give you more confirmation a zone is a good one.